So as what the definition of LIFO reserve, the earnings are actually reserved in the lower cost of inventory based on the cost flow assumption LIFO, last in first out, because last inventory is considered higher cost. First inventory is considered lower cost. If we use LIFO, higher cost inventory are expense. So LIFO usually report higher cost of goods sold and lower earnings, but also lower ending balance of inventory. And the LIFO liquidation happens when the company, the units sold is greater than the units purchased. Remember the equation, the beginning balance of inventory plus purchase equals to ending balance of inventory cost of goods sold. So if the company have more units sold than the purchase, the number of units in ending inventory will be less than the number of units of beginning inventory. So it indicates the older inventory now are sold. We usually assume the older inventory are lower cost. If this lower cost inventory are sold, that will result in greater difference between the price and the cost. The great difference between price and cost is greater profits. So LIFO liquidation usually result in a greater earnings for company. Originally, the company has 50,000 units, 20,000 in the beginning, purchase 30. The cost is increasing. 16 for the beginning inventory, 20 per unit for the purchase. If the company this year sold 45, which is greater than the purchase, that means the older inventory or the beginning inventory will be sold or released. Because the company will result in greater margin because these costs of inventory are lower, $4 difference. If we assume the company just sold 30,000 units, based on LIFO, only this part of inventory is sold, right? And this part of inventory, the cost was $20 per unit. So the margin will be lower. So that's why I said when the company sold more inventory than the purchase, the older inventory here, the beginning balance of inventory will be liquid. In other words, these inventory are sold. So the lower cost inventory will result in higher earnings because lower cost of inventory result in lower cost of goods sold. This example is said the FIFO was used. So the FIFO inventory is 36,000 greater. FIFO inventory is greater than LIFO inventory. The difference is 36 million. At the same time, we know LIFO will result in greater cost of goods sold than FIFO. The difference was $36 million. The lower cost of goods sold will result in higher income before tax. The difference still 36. So the impact on the earnings, we need to multiply 1 minus the effective tax rate. So the net impact will be 21.6. FIFO has greater inventory value than the LIFO. But LIFO will report a greater cost of goods sold than FIFO. Because of the higher cost of goods sold for LIFO, FIFO will report a greater income before tax than LIFO. The difference was 36. The net income difference is this multiply 1 minus effective tax rate.